Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. For those new to my channel, it would be helpful to explain my theory on the AMC and APE trade. This is not financial advice, and I am not a financial advisor. I will never tell you to buy, sell, or hold any security or cryptocurrency. However, I assert that the predatory short hedge funds have not covered yet and will remain short and persist in all their activities until they're forced to cover. I believe covering for many of them would be a catastrophic event, and that certain agencies will actually assist them using tactics as extreme as removing the buy button and/or misusing halts to protect them from spikes in stock price or a short covering event. I have no confidence that any regulator or agency is coming to help us in the face of all the manipulation. Not the SEC, FINRA, DTCC, LULD Committee, the DOJ, the Treasury, or the Fed. I would only add, the financial media will continue to pretend nothing nefarious is going on at its best and will actually persist in planting hit pieces against the company at its worst. I also discount any theory that just returning to profitability or pre-pandemic levels of performance for AMC will force the shorts to cover, and I would point to GameStop as a prime example to support this claim. I also believe as long as Morgan Stanley not only sits on our board of directors but leads it, there is zero chance Adam Aron or the AMC management team will do anything deliberately to hurt Wall Street's interests. I would add that Adam and our board have absolutely zero interest in a short covering event or MOAS, and that they deliberately downplay or ignore positive events that could spike the stock simply because even a small spike in the stock price could morph into a short covering event with cost to borrow at elevated levels, and they know a significant unknown number of shareholders will exit the stock and stop supporting the company to the degree which they are presently if there's a squeeze. And while I'm quick to praise Adam Aron and his management team for modernizing and diversifying AMC's business model, it is clear that this same team may be engaged in a scheme to bleed the company dry by paying themselves outrageous cash and stock bonuses that exceed their base salaries, all while the company has amassed $5 billion in debt, had to struggle with a crippling pandemic, and are handicapped by a severe reduction in films to display, a problem that persists to this very moment. This team sells massive amounts of our stock, and I cannot name one company insider that has actually purchased the stock over the past 5 years, with the exception of Antara, a relationship that has been nothing short of a disaster, with Antara even joining the list of entities shorting the stock. It is for these reasons I voted no, because I believe diluting in the manner which Adam plans to, coupled with a reverse split, will severely punish the stockholders yet again. In contrast to the other YouTubers and Twitter personalities out there, I have actually offered a third path of direction other than the yes or no crowd's binary options of massive dilution and split or suffer an immediate bankruptcy. No, I contend that the company should devise a schedule to pay down debt tied to our performance at the box office over a specific time window. Furthermore, the goal of the plan would be to achieve the same debt-to-equity ratio that the company had pre-pandemic. I would also suspend cash bonuses that exceed base salaries and suspend stock award bonuses until the company is out of harm's way, or at minimum, until the end of 2023. For those of you that think I'm a shill or I'm wrongly criticizing Adam Aron and the management team, I would only reply that if you visit secform4.com, you will learn that over the past 5 years, this same team has sold over $1 billion of our stock, and that the sole purchase was executed by Antara Capital, a deal which not one ape, yes or no camp, can possibly claim was good for anyone with the exception of Himanshu Gulati. Albert Einstein famously said, "If you can't explain it to a 6-year-old, you don't understand it yourself." Let's see if we could meet that standard together. Now we are going to start at microtrends, and I want to show you that we began amassing debt far before the pandemic. This chart depicts long-term debt, shareholders' equity, and debt-to-equity ratio, going back 10 years to 2013. Adam Aron joined the firm in late 2015. That's that first arrow on the top chart. You can see the following year long-term debt rose to $4.36 billion. Now, the WHO declared a pandemic on March 11, 2020. That's the smaller arrow on the middle chart titled Shareholders' Equity. So our debt issues began far before the pandemic arrived. According to Investopedia, the debt-to-equity ratio is a ratio that is used to evaluate a company's financial leverage and is calculated by dividing a company's total liabilities by its shareholder equity. Now, to be fair to Adam, during that time with that debt, we went from being the second largest theater chain in the United States and in the world to the first. And you could see in March 31st of 2018, we had a debt-to-equity ratio of 2.077, considered healthy. And now it's negative 1.885, but is heading in the right direction. My main problem, guys, is in 2020, the year of the pandemic, we were already $5 billion in debt. Hollywood would begin starving us for product, but we continued to pay outrageous bonuses to our executives. Take our CFO, for example, Sean Goodman. His base pay in 2020 was $622,000, but his non-stock cash bonus exceeded that, $761,000. Then he was awarded $2,861,000 worth of our stock. Now, over the past 5 years, this same executive has sold $17,752,000 worth of stock and has never purchased a single share during this time period. Many of our other executives have exactly the same template. Now let's revisit that same year. Our debt-to-equity ratio, March 31st, 2020, dropped to a negative 4.75. Now let's see if we could make this so easy a 6-year-old could understand it. Let's say you own a gas station named Boss Blunt's Gas Station, and it's worth $1 million, but you owe your creditors $4,750,000. That's a debt-to-equity ratio of negative 4.75. Now, this is during a pandemic, so far fewer customers are coming in. Your gas supplier has informed you your station will be receiving at least 50% less gas to sell. You've laid off everyone except the manager, who you're paying $1,000 per week or $52,000 a year. Now, under these conditions, would you pay him a cash bonus 22% higher than his entire base salary, or an additional $63,440, and then pay him a stock bonus 4.5 times his base salary, or an additional $234,000? Well, that's exactly what we did for many of our senior executives. Now let's add that we're in a rising interest rate environment. So the debt service payments on your gas station are only going to go up. How long could we afford to do this? Keeping in mind, we're still not getting the same amount of gas to sell that we were prior to the pandemic. Do you understand now? And in case you were wondering, our board of directors is really no different. Of course, they're earning fees and stock awards in 2020, and yet not a single buy in the past 5 years, only sells. In fact, if you add all of our AMC executives together and the board of directors, they own less than 0.5% of our stock. I guess it's safe to say they are committed sellers. And maybe that's the reason why, for the first time, we're starting to see significant drops in AMC held by all institutions. The bottom line for me is we should avoid over-diluting and a reverse split and instead opt for a realistic debt reduction plan tied to top-line revenue to return the company to a healthy pre-pandemic debt-to-equity ratio. We can achieve that by halting bonuses that exceed base salaries and ending stock awards until at least the close of 2023. Also, if the current trend continues, we could catch 2019, ending the short narrative that the theaters are dead once and for all. By the end of the first quarter of 2019, we had 302 releases. By the end of the first quarter in 2023, we only had 185. So as we increase the number of releases, we increase our chances of catching 2019. Our average per film is up from 7.9 million to 9.3 million. So we're doing more with less. And we've got a lot to look forward to. We've got The Little Mermaid, Fast X, Kandahar, another Spider-Man. We just need management to treat us as well as they treat Antara for a change. We just need management to tighten their belt a little bit so that we could reduce our debt load. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.